This latest announcement from Vanguard, the second largest fund manager in the world, which is just behind BlackRock in terms of assets under management at $10.4 trillion as of 2024, just confirmed the inevitable. The fact that we're likely going to experience the biggest bull market in crypto history. And this is all while the CTO of Ripple and one of the earliest cryptographers in history, David Schwartz, talks about how tokenized assets and on-chain credit are bridging the gap between TradFi and DeFi, and how the XRP ledger is the perfect foundation to support this shift. So much so that even one of the largest offshore exchanges just announced that they listed RLUSD, and the trading pairs are against the Tether, Bitcoin, Ethereum, XRP, and MNT. And many talking heads have been sharing how they believe we are now in a new structure of a market cycle. In the past, we've experienced 4-year cycles. However, this time around truly is different, and it's likely we get at least a 5 to a 6-year cycle today. And that's the fact that Vanguard just confirmed something that is going to push this crypto market into a mega bull market cycle, probably through the next year and into potentially even 2027. In other words, this truly is the death of that typical 4-year cycle, because when it comes to institutional adoption, there's just so much money that needs to flow into the crypto space, and it can't all happen at once. So as we get more regulatory clarity and potentially that market structure bill by the end of the year, you're going to see fund managers, pensions, retirements, heck, mutual funds starting to deploy capital into the crypto market. And again, if they were going to allocate, let's say 2 to 5% of all of their capital into crypto, which will push that crypto market cap to at least $10 trillion and will likely push XRP up to new all-time highs, they're not going to do it all at once. It's more likely that they're going to allocate over time, dependent on their own strategies. Now, that said, we're also going to see tokenized assets continue to grow. Right now, we're sitting on $30 trillion of asset tokenization. We just saw a major partnership between Ripple and some key players in the banking and financial industry. And in this latest video from the CTO of Ripple, David Schwartz, he talks about how the XRPL is the perfect foundation and fit for these key applications. Let's have a listen.
Tech is coming for finance with or without blockchain. That was going to happen. New corporates, companies like Amazon and Uber need more financial services than the current system is able to provide them. And the blockchain technologies are in the right place at the right time. I'm David Schwartz, CTO at Ripple and co-creator of the XRP ledger. I do think that DeFi, broadly speaking, meaning blockchain, smart contracts, and the whole ecosystem that's being built around it, is going to take a huge bite out of TradFi over the next couple of years. The big challenge is the blockchain space is going to have to produce the services that people want from the financial system. It can't just be collectibles, and it can't just be, seeking very high reward at very high risk. But I do think that we are going to see the DeFi space, especially with the tools that institutional adoption is going to provide, with assets to things like tokenized real world assets, tokenized loan and real estate portfolios. That's going to produce the products and services that people want out of a financial system. I don't think there's a tension between institutional adoption and decentralization. I think that ecosystems are interested in layer 1 blockchains because of their decentralization, because of their neutrality. So I think institutions will see that the neutrality of blockchains is a positive for them rather than a negative, because I think ultimately that will be the selling point. And I think that's all going to lead to just massive expansion and growth in the space.
And so with all this institutional adoption, not just from an ETF level, which again, we're expecting an XRP ETF sometime this year. So it's more than just investing into the token itself. It's also use of this token inside of a grander ecosystem when it comes to global remittances, transactions using the RLUSD stablecoin, real world assets, and more, which is going to drive the entire crypto market into a major end of the year cycle, but arguably will last into 2026. And Raoul Pal explains it pretty well. He always talks about something called the banana zone, which consistently occurs at the end of a 4-year cycle, but how this time around we have widened. And if you look at this chart here, we're going to see in second, it's pretty visible that by now, usually we've already experienced that parabolic move, which looks like a banana. But instead, we're still in that early phase, even if it's coming in a bit late. Let's watch this.
We are now still in the early phase of phase 2. This is not a phase 2 correction. We've barely broken out. In fact, most other assets, thinking about stuff like total market cap, X, Bitcoin and ETH, haven't yet broken. Now think of the banana zone here. All of these previous 3 were all only one period wide, this 1 year. This one will be wider. So which is why the market looks less parabolic at this stage. But the parabola will occur, and Julian showed you with that work earlier, and we will have a phase 2 correction.
And I think the reason that this is widening is because we do have a lot of institutions which tend to be more sophisticated investors, and they can make money on the upside, they can make money on the downside, they can apply all sorts of risk adverse strategies using options, calls, puts, you name it. And so with adoption at an institutional level, you're going to see more chop in the market. You're likely going to see the structure that we typically saw under retail investment and FOMO change. And so much so that even a finance professor talked about how after 25 years of teaching finance, he realized that the only way out is crypto. Let's have a listen.
I didn't realize that if the average year the money printer goes, call it 8 to 10%, even in the Western countries, even in the OECD nations, and the average return on the S&P 500 is, call it 9-ish%, including dividends, maybe 9.7, maybe a little less, that it means that all of the work of the S&P 500, all of the value created there is actually the money printer. That to me was startling. I mean, to think about that, the fundamental notion that in a closed system or even an open system, when you're printing money at the rate of 8 to 10% a year, everything is losing value, and the things that appear to be gaining value are not gaining value. They're just keeping you even. So you can put all your money in the S&P 500 and you're not gaining any relative wealth at all. That's a startling insight. I mean, when you really think about the entire value of the S&P 500, on average over a long period of time, not even a long period of time, is equivalent to the money printer. That's, to me, a shock. And it was a shock that said, oh my goodness, how do you think about creating wealth that is relatively greater in this economy? And you have to look hard. The other thing you can imagine is I could tell you about Sharpe ratios and diversification. I could tell you all these different things. And, you know, it's interesting. You can take a concept like diversification of risk, and at a top level, it can be a very powerful and useful tool. But if you are so focused on the mechanistic aspect of that, you can step back and miss the forest, which is in a highly diversified portfolio, it's unbelievably hard to pick up relative amounts of wealth. It is. Diversifying your portfolio, however you do it, is by and large going to reduce your incremental gain in wealth, irrespective of the Sharpe ratio. It's concentration of capital in specific bets that outperform the money printer where you actually create wealth. That was a shock to me. I just didn't get it. I didn't understand it. Even though I taught finance for 20 plus years, I'm still a professor at NYU Stern, at Stern Business School. I've taught strategy and finance for technology, media, and entertainment companies. I'm on a 2-year hiatus, but I'll be presumably going back in the spring. For 25 years, I have almost, actually more than 1,000 former students. And I still didn't get it until I'm age 58. That's the Bitcoin journey. That's the Bitcoin journey.
In other words, this is something I learned early on. The reality is, in order to protect wealth, you should diversify. But in order to create wealth, you need to concentrate. When you think about the wealthiest people on planet Earth, and we're not talking about wealth created through managing other people's money or inherited wealth, we're talking about the richest of the rich that are first generation billionaires. Virtually all of them became billionaires by concentrating their energy, and they owned the majority of a stock in any one company they built. Well, the same would be true in markets. You have to concentrate into the best performers that are going to be here, the 500-pound gorillas in the room over the next decade. And obviously, what's good for Bitcoin is good for XRP, as we've already seen loads of capital flow into XRP and arguably saw it outperform Bitcoin at the start of the year for larger gains. I expect that same type of a breakout move to happen either end of year or start of next year. And Vanguard is now playing ball as the second largest asset manager on earth, is prepping crypto ETF access for clients. So think about that. Yes, they're going to launch right away with the only ETFs available, which are Bitcoin and Ethereum. But when we get that XRP ETF that isn't an ETP, that's higher fees or in a basket of other products, we're talking just a straight up one-for-one spot XRP ETF. They will be offering that to their clients as well. And what makes this super interesting is the fact that Ripple's former head of partnerships, Eric Van Miltenberg, is now advising Van Eck, which is the same firm Ripple has featured at Swell. Combine that with Vanguard, and this looks like a recipe for a major bull market cycle into the next year.